Hello, my name is Belinda Mucklow, and I'm on the faculty at the University of Wisconsin. I also happen to be a CFA charter holder. What we're doing here is the core video for financial statement analysis. And I imagine that if you are watching this video, it is because you have very little background in accounting. And the thought of looking at accounting is probably pretty daunting. So what I'm going to try and do here is make it a little bit more understandable for you, try and give you some intuition where it exists, and there really is a fair amount of intuition behind accounting, believe it or not, and make you comfortable and get ready for the standard LOSs that you're going to have to do. Notably, accounting is a huge, huge part of Level 1 and Level 2. So any time you spend trying to understand the fundamentals of accounting is going to pay off big dividends for you. So let's just start off with a little bit of background before we actually get into the nitty-gritty of what is in each financial statement. So first of all, publicly traded securities. Those companies that have publicly traded securities are required generally to produce financial statements. Certainly in the US, and most of our discussion will be about the US because that's the subject of the LOSs, they're required by the SEC to produce these financial statements. And we'll discuss exactly what the financial statements are in a minute. So what is the purpose of these financial statements? I mean, there can be lots of reasons for producing financial statements, but the reasons for the ones that the SEC require are the primary objective of these financial statements is to provide information that is useful to creditors and investors in making decisions. Now, this makes sense if you think about it. We're making decisions. Investors are trying to decide whether to buy, hold, sell the stock. The creditors are trying to decide whether they're going to lend money to them or whether they're not going to lend money, whether they're going to buy the bonds, not buy the bonds. So they want some information that's going to help them with that. So that is the primary objective of the financial statements that are provided. Now, so we know we have to prepare these financial statements, but how are we going to do it? I mean, if we let every company just prepare any statements any old how, we would have a huge mess. It would be bedlam. So what happens is there are a set of rules which tell you how you are going to prepare these financial statements. Now, in the US, these rules are called generally accepted accounting principles. And they're otherwise known, they're abbreviated to GAAP, G-A-A-P, pronounced GAAP. So when I talk about GAAP, this is it. These are the rules in the US. So this is the US rules, are generally accepted accounting principles. Now, each country will have its own set of rules. As I said, the focus of the study sessions here is generally the US rules. However, there is a move to incorporating the international rules, and there are international accounting standards, and these are called IAS, not surprisingly. So these are other ones that you're going to come across in some of the readings, because as we go through and these become finished, they're sort of been in process for quite a while, that they're going to be very similar. It's just going to be a couple of areas that they differ. Now, the question is, who sets these rules? Well, in the US, in theory, the SEC, and I forgot to tell you, the SEC is the Securities and Exchange Commission. In the US, the SEC has the ultimate authority, but it generally does not set the rules. It defers the setting of the rules to the Financial Accounting Standards Board. And this is otherwise known as FASB. So it's FASB. So in the US, FASB generally sets the rules by which you prepare the financial statements. These rules are called GAAP, Generally Accepted Accounting Principles. Internationally, there is the International Accounting Standards Board, the IASB, which sets the international accounting standards. And what we're going to do is we're going to discuss some of the rules, some of the very basic rules, and whatever country, other countries like the UK, will have very similar rules. They might vary on some things, but a lot of the underlying principles are the same for the international in the US and other countries. All right, so we've already established that in the US that firms with publicly traded securities are required to provide statements. These are statements, we'll call them GAAP statements because they're prepared. The rules they use to prepare them are prepared. The rules are called GAAP. So what statements do they have to produce? Well, they have to produce an income statement, and we're going to abbreviate that IS. And then the balance sheet, the abbreviation we'll use from here on in is BS. And then the statement of cash flows and the statement of stockholders' equity. There's no real standard abbreviation for this one. I would have to say the statement of stockholders' equity is sort of the forgotten statement. If you ask people what are the statements, they'll name these three and sort of forget this one. So we're going to go through these in detail. We're going to spend most of our time on the income statement and balance sheet here. But as I said, we'll go through these in detail in a minute. But also notice that when they produce these, they will also produce footnotes. Now, the footnotes always accompany these financial statements and are an integral part of the statements because they give a lot of detail about the items you see in the statements. So they're an integral part of the financial statements. Notice FS is an abbreviation for financial statements. Now, what you should not do is confuse these with the tax statements. What happens is companies will have to prepare statements for the taxman. Now, these are set by a completely different set of rules. I mean, they have different objectives. We could argue the objective is to collect as much tax as possible, but what happens is the government in any country normally uses their rules for taxes to stimulate the economy, whatever else they want to do. So what can happen is that just because something changes up here doesn't mean it changes for the amount you're going to pay the taxman, because they're going to use a completely different set of rules. The rules we're concerned with here are the GAAP. So that's what we're going to be talking about. And the rare occasions that we refer to taxes, we'll make it quite clear that we're talking about taxes. And you should be extremely grateful we don't have to look at taxes because the half-life of a tax rule is about 1.5 years. So we're going to be concerned with GAAP statements. So I've already said that they are required to provide statements to the SEC in the US. So when and how do they provide these? Well, what they have to do is they will have to provide a 10K annually. So this is the annual financial statements, and they are audited. They're changing the length of time as we speak. They're going to try and make it, you must do it within 60 days. That will be the new rule as of 2005, that these must be filed. Then you also have the 10Qs. These are the quarterly financial statements that must be filed with the SEC, but these are unaudited. Then other statements that they must file, they're going to file things like the 8K, and that will be material unscheduled events, such as a change in the board of directors, a change in senior officers. The big one is a change in auditors. Another one they would have to file is a proxy statement. That is matters to be voted on at the annual general meeting.